The current furor about gold is mostly confined to the gold community. It's like you went to an evangelical church in the U.S. South and you asked the choir if they believed in God. The answer is likely yes. Gold is still grossly underowned worldwide. I believe specifically that the U.S. dollar loses 75% of its purchasing power in an absolute sense over the next 10 years. It wouldn't be surprising to see the gold price increase in nominal terms in a way that reflects the deterioration in the purchasing power of the U.S. dollar, which means a twofold or threefold or fourfold increase in the nominal, which is to say U.S. dollar quoted price of gold, is not unlikely. If you believe in the government's number, the CPI, you don't believe in gold. But I don't believe in the CPI. First of all, when it's inconvenient for them, it doesn't include food or fuel. And any index that doesn't include lunch is of no particular interest to me. And what I'm seeing is a market where there's absolutely no securities analysis taking place.
What are the most valuable lessons, if you had to say, let's say the top 2 or 3 that you've learned in allocating your capital to miners?
Contrarian or victim, go where there's hate.
Hey everyone, this podcast is not investment advice, and I'm certainly not a financial advisor. Just a guy who spends too much time reading about markets. Before investing, do your own research, talk to a licensed advisor, and remember, risk is part of the game. All right, welcome back to another pod. Rick Rule has been allocating capital in commodities and natural resources for more than 5 decades across booms, busts, manias, and long stretches of what some investors might even call boring, but not Rick. He's the founder of Rule Investment Media, and his edge, I think, isn't price prediction, but process, discipline, finding the unloved, respect for history, and surviving and also thriving in cycles that punish impatience. So when Rick joined me last May 2024, gold was trading near $2,500. Natural gas was deeply out of favor, and capital was relatively scarce across the resource sector. Nearly 2 years later, prices, sentiment, and risks have shifted, but many of the underlying truths have not. So today's conversation is about what experience teaches, of which Rick has a lot, what still matters, and how rational investors navigate the current commodity environment. So Rick, welcome back to the pod.
Pleasure. What a well-timed interview that was. Lovely.
I want to get start on the topical stuff first, which is gold. It's nearly doubled since we last spoke, yet at least from my vantage point, I think most investors still seem disengaged with the space overall. That's an assumption on my behalf, but what does that tell you about where we are in the cycle? Or what do you think about the timing of where we are in this current gold cycle?
Aaron, I think that's an accurate assessment. I talk to investors of all stripes, and I need to say that the current furor about gold is mostly confined to the gold community.
Mm-hmm.
It's like you went to an evangelical church in the U.S. South and you asked the choir if they believed in God. The answer is likely yes. Gold is still grossly underowned worldwide. That being said, it's not as cheap as it was. The fact that the gold price has doubled means in arithmetic terms it's half as attractive. It seems that for most people, the narrative has to be demonstrated by price action. And when the price action has demonstrated the efficacy of the narrative, much of the advantage of the narrative is gone. So I believe in gold, the easy money has been made. But I also believe that the reason that you own it remains very much intact. And let me explain. In my lifetime, the primary determinant in the direction of the gold price has been the faith in the maintenance of purchasing power in fiat currency denominated savings instruments. And I believe that those fears with regards to all currencies, including the US dollar, are high. And I believe that they should be. I believe specifically that the US dollar loses 75% of its purchasing power in an absolute sense over the next 10 years. The same destruction of purchasing power, according to the Congressional Budget Office, that occurred during the period 1970 to 1980. It's worthy to note that since the establishment of the Federal Reserve, the U.S. dollar has lost 97% of its purchasing power after technological innovation. And I suspect that the next 10 years sees us lose 75% of the 3%. If that's true, it wouldn't be surprising to see the gold price increase in nominal terms in a way that reflects the deterioration in the purchasing power of the U.S. dollar in terms, which means a twofold or threefold or fourfold increase in the nominal, which is to say U.S. dollar quoted price of gold, is not unlikely. Or, put a different way, in 1970, a high-quality bespoke men's suit cost about $40, and an ounce of gold sold for $35. Today, a bespoke men's suit, probably $4,200, $4,300. And it could be that that same suit 10 years from now goes for $16,000 US dollars. If you take this math just a little bit further, if you believe that inflation in the United States, first of all, equates to the diminishment of the purchasing power of the US dollar, which is, from my point of view, functional inflation. If you believe in the government's number, the CPI, you don't believe in gold. But I don't believe in the CPI. First of all, when it's inefficient, when it's, inconvenient for them, it doesn't include food or fuel. And any index that doesn't include lunch is of no particular interest to me. But their cost of living index also doesn't include tax, which makes it a very silly cost of living index. I've done an informal calculation of the basket of goods and services which I buy. And by the way, I'm an old cheapskate. I don't buy much. And the basket of goods and services that I buy has been becoming nominally more expensive at 8% compounded since the year 2020. Now, here's where the rub comes in. The world's benchmark savings instrument is the U.S. 10-year Treasury, which pays 4.2. If you believe the CPI at 2.9, that's not a bad yield. 120 basis points yield, not bad. But if you believe, as I do, that the purchasing power of the currency is declining at 8, what that means is you're not making 4.2, you're losing 3.8. And if you lose 3.8 compounded over 10 years, it means that you gave the U.S. government $100,000 and they gave you back about $50,000 in purchasing power after compounding. Not such a good deal. If, to remind ourselves, the discussion about the increase in the gold price has to do with a lack of faith in the purchasing power of the U.S. dollar, the U.S. government is guaranteeing that. And it's the first guarantee that they've made me in my lifetime that I believe that they'll honor.
Yeah, I agree with your inflation rate thesis too. I'd say in Canada, it's probably 8 to 12%, somewhere around there. But that brings up another interesting point too, is when you look at individual investors who are investing to try to improve their standing in life or their future, securing their future. You take the S&P, for example, average returns about 11% over the last 100 years. If inflation is 8% and the S&P continues to maintain its average, the net gain is very, very minimal, which makes it very challenging for someone who's trying to get ahead in this world by investing to actually do so. So with that being said, what is, on a high level, what recommendation do you have for somebody who's in their 30s or 40s or 50s who's actively investing and trying to get ahead?
The first is to quantify the problem, which is what I've attempted to do for people. Most people don't want to confront the reality that their purchasing power, the purchasing power of their savings and their earnings, is going to decline in that precipitous a fashion. So the first thing is to face the problem and acknowledge it. The second is to take action. The action that you take depends on your personal circumstance. The first investment that a young person can make is in themselves. You realize over time that your real earnings are a function of the utility that you generate for your consumer and hence for your employer. They aren't necessarily your wages. If your employer can't make money employing you, you're going to get fired. And if your customer can't make money on your efforts, he's going to fire your employer, which means you're going to get fired. So the first thing is to invest in yourselves and your skill sets. We live in a wonderful economy right now for people who have developed sufficient skill that they can deliver excess utility in the economy. Unfortunately, that isn't the predominant of people in the economy. Understanding that your income isn't tied to showing up, but rather to producing, is the first part in getting ahead over time. It reduces complacency. Whether you like the outcome or not, it's important to know what your probabilities of material success is over time and what you can do to change that. The second thing is that if you understand what the deterioration of the purchasing power of your savings and earnings does over time, you have the ability to increase your savings rate today. Capital is the delta between the utility that you generate for others and the utility that you consume for yourself. There's an old ditty that I learned when I was a very young man. It goes like this, and I wish your Parliament, our Congress, when your outgo exceeds your income, your upkeep becomes your downfall. You are not going to be able to survive well the next 10 years if you are generating all of your wealth. Your wealth needs to generate wealth. And you can't be a capitalist without capital. That means that you need to save more than you can earn in very simple terms. And you need, over the next 10 years, to save more of what you earn than you have over the last 40, because the circumstance in front of you is changing. And then, after we've taken care of those two things, after we've invested in ourselves, and we've altered our lifestyle to support our earnings capability, then we have to worry about investing. And I would suggest to you that the period 1982 to 2022 was the most benign period for investing in human history. The supremacy of the US dollar, and by proxy the Canadian dollar, the decline in real and nominal interest rates, the demographic boom presented by the baby boomers coming into their savings and investment years, globalization in the best sense, the accommodation of 2 billion people, maybe more, into the labor force, people in frontier markets, females, a circumstance that's unlikely in the near term to be repeated. So while the next 10 years won't be a crisis necessarily, they won't be as easy.
Mm-hmm.
The stuff that's worked over the last 40 years, one of which was to buy the long bond and let the lower interest rate make the bond more valuable. That game came to a screeching halt in 2022. The long bond now, Franz Pick described it as a certificate of guaranteed confiscation. And I think, sadly, that's accurate. And I think we're coming into a period. By the way, I'm not passing a judgment onto the value of general market securities because I don't know. I know how to value resource securities, and I know how to value conventional financial services companies, bank, wealth managers, asset managers, but I don't know what NVIDIA is worth, and I don't know what Loblaws is worth. So I'm not going to tell you the S&P is overvalued or undervalued because I don't know. But to the extent that the valuations are determined partly by the direction of interest rates, I would suggest that the market's beginning to reassert control over the interest rates. And the interest rates over time in the market will reflect increased interest rates, which means, if that's true, that the normally accepted valuation methods will become more and more and more conservative. So don't be complacent. I will also tell you, and I'm certain of this, that with all of the conflicting circumstances in the market, that the market's going to be much more volatile than they have been in the past. Now, if you're a disciplined investor, a value-oriented investor, one who doesn't trade narrative, but rather than trades arithmetic, this volatility is a very good thing. Volatile declines are otherwise known as periodic sales. And periodic sales are good. It's just that most people don't like their own goods going on sale, and they tend to freak out and sell at bottoms. And you're going to have to guard against that, because the next 10 years is going to be much more volatile than the last 40 have been. And I don't just mean periodic volatility like 2008. I mean ongoing, cyclical, repeated volatility.
Interesting.
I've learned in my markets, and my markets are more cyclical than most markets, that in order for me to succeed, in addition to having a sense of value, I have to be a contrarian. In cyclical capital-intensive markets, you are either a contrarian or going to be a victim. Ironically, that makes my markets much easier. I find a commodity that's hated, where demand for the commodity is certain relative to the material needs of humankind over 5 or 10 years, where that commodity is priced at a discount to the cost of production, where the industry is in liquidation, hence hated by capital market. I've learned to buy the hell out of that commodity.
In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. So if you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. Americans may be eligible for a $100 funding bonus when opening and funding an account with iTrustCapital.
Let's look at, as an example, the oil markets during COVID. You may recall that the oil price collapsed from $70 to briefly zero before balancing out at 20. Now, 20 is an interesting number because it was estimated at the time that the absolute cost of producing a barrel of oil, including tax and the cost of capital, exceeded $50 a barrel. So the industry made the stuff for 50, they sold it for 20. They did it 98 million times a day. And of course, that wasn't very attractive. If you thought about it from a current price earnings viewpoint, you were extremely discouraged. But if you thought about it from a different viewpoint, one that goes like this: if the price of oil doesn't go up to cover the cost of capital, oil becomes unavailable. Ergo, either the price of oil goes to $60 or my car won't start in 5 years. What's more likely to occur?
Okay.
If you look at it from that point of view, investing in oil stocks in 2021 was a no-brainer. And for somebody like myself with 45 years of experience, it was indeed a no-brainer. The difficulty that commodity investors have is that, let's say that the last time we talked in May 2024, somebody was attracted to the gold thesis because they bought our argument that it had to go up. But they said, maybe it goes lower first. Now that thesis has been validated with $4,400 gold, remember that the gold price has doubled. A lot of the result that we thought would be a consequence of that thesis has already occurred.
Yeah.
In other words, the benefit of adopting the narrative, there's $2,000 per ounce less benefit, I guess is what I'm trying to say.
When we last spoke, and I think I know the answer now based on your inflation point, but you thought gold hitting 7 to 8K was plausible and probably probable at the time, I think you said. Obviously, I think you still feel that way.
Yeah. I'm too old to put an exact number on it, not because I'm afraid of being wrong, but because I know I'm going to be wrong. It's a certainty. But let me just say that if the U.S. dollar declines, if the purchasing power of the U.S. dollar declines by 75%, I think an arithmetic increase in the price of gold that mirrors to some degree the deterioration of the purchasing power of the US dollar is going to occur. Now, if we had really high interest rates, like we had at the end of the period of the 1970s, what happens is the deterioration of the value of the purchasing power stops. And hence the gold price decline stops too. So you need to understand the variables. But let's think about the interest rate that would be required for that. In a historic context, the U.S. 10-year Treasury yields about 150 basis points positive to the rate of inflation. If the rate of inflation is 8, that would suggest a Treasury decline from 4.2 to 9.5. That would present an interesting challenge for the U.S. government in terms of servicing $38 trillion in recourse liabilities. One needs to ask what the probability of a 9.5 prime is. Maybe of more interest to your listeners, those that are American at least, traditionally the 30-year fixed mortgage with a 20% down payment, not like today, yields 250 basis points above the rate of inflation. That would suggest a 10.5% 30-year fixed. What might that do to the American housing market?
Devastation.
Yeah. Now, and I've seen this, right? I mean, I went through the last part of the decade of the 70s, and let me tell you from the experience of a young guy who borrowed a lot of money, it was decidedly unpleasant.
Yeah. The I've been doing this not nearly as long as you, but I've been in this space now for almost 20 years, investing in commodities and the associated producers and juniors and so forth. I have PTSD from some of the bear markets because they last so long. So I'm trying to get a gauge of, retail participation because I don't like to be in crowded trades. I'm sure you're similar.
Yep.
It feels like like retail participation in precious metals has picked up, I'd say, over the last 6 months. This is anecdotal, just what I'm seeing from emails and chatter and so forth. Is gold still function? Like, are people buying it for insurance right now, do you think? Or are we starting to see speculation creep back into the gold space?
Gold itself, yes. It's very much still being bought as insurance.
Okay.
The predominant gold buyer is still the central banks. And they're buying it to shield themselves from the arithmetic of the US dollar, but also from the extraterritorial imposition of US power. They're buying it because the US government gives them no second choice.
Mm-hmm.
The junior gold stocks are an entirely different matter.
Mm-hmm.
The junior gold stocks were a really hated asset class 5 years ago. A chart of the GDXJ looked like the electrocardiogram of a corpse. And in the 3 prior precious metals bull markets of my lifetime, they followed a very predictable path in terms of the flow of money. From gold itself to the best of the best, to the senior producers, to the best of the rest, to the single asset producers, to the developers, to the juniors. This market went from Franco-Nevada to amalgamated moose pasture in about 8 months. And I would suggest to you that the market that we're seeing now in the rank and file junior is crazy. It's totally insane. I would argue further, Aaron, and your Canadian counterparts will hate me for saying this, but if you merged every public junior in the world, there's 2,500 of them or something, made one company, Junior Explorco, that company in a very good year would lose $2 billion. In a bad year to lose $10 billion. So what should we pay for that company? Should we pay 8 times losses? 12 times losses? Maybe in a bull market, 15 times losses? That statement hides the fact that about 10% of those issuers generate so much utility that they add legitimacy and even luster to the sector. Mm-hmm. And what I'm seeing is a market where there's absolutely no securities analysis taking place. The valuation differences between the high-quality juniors run by good guys and the absolute pieces of dung is low. I'm getting calls now from usually junior desk guys, and at the investment banks, the senior desk guys know better than to call me mostly. But the junior guys will call up and they'll say, Rick, pardon my jocular reference, but they'll say, we're doing a deal next week. We're going to go up live on Consolidated, right? And we're doing a deal with a full 3-year warrant, and the warrant's at only a 50% step up to the price. And I'll say, really, what's the pre-money? Oh, well, that's the good news. The pre-money in this thing's only $12 million. And they say, oh, really? Only? What in this company that you think is worth $12 million? They have an option to acquire a property that will cause them to have to spend $5 million. In other words, they have an option to spend $5 million on something that has a transfer value today of 0. And you're saying that's only worth $12 million. And you're saying the fact that I have a 3-year option on a 30 years, on a 50% step up on something which is $12 million overvalued, that I should appreciate.
Yeah.
Let's look at the management team. A butcher, a baker, and a candlestick maker, right? You get my point.
I get it.
When you have this incredible rash of financing in the Canadian dealer network, what you have is the management teams of 500 companies telling you simultaneously, because they're trading their stock for your money, that your money is more valuable than their stock. And collectively, they're right. Doesn't mean the market can't go up. It just means that the market is stupidly popular and stupidly expensive.
I mean, outside of, pastures or the moose pasture argument or fact, do you think that the capital structures early on, like the people behind the deals have got too greedy, and that is at a pretty big detriment to the junior space? Do you think that is killing the junior space? Structures.
What I can say is that the quality of the people in the top 10% juniors is way better than it was when I was young. Way better. The third generation of junior practitioner is an order of magnitude better than we were.
Sure.
But the length and breadth of the market, which is to say the other 90%, that's still occupied by the lame, the halt, and the blind.
I want to pick your brain because I'm trying to be a better allocator. It's been 20 years and I still have a lot to learn. What has experience taught you about the mining space and investing within it that no spreadsheet ever could? Like, what are the most valuable lessons, if you had to say, let's say the top 2 or 3 that you've learned in allocating your capital to miners?
Contrarian or victim. Go where there's hate. By the way, there's not much hate out there right now. The second thing, and it's probably the first thing, is Pareto's Law. For those of your listeners who don't know what that is, that's the social science dictum around the 80-20 principle. The fact that 20% of the population base does 80% of the work. What's important to know in terms of applying that to investment is that it's a bell-shaped curve. It's a performance dispersal curve. So if you look at any particular function, let's call exploration a function, the 20% of the population base engaged in exploration generates 80% of the wealth. A less well-known fact is that a different 20% of the population generates 80% of the aggravation. So your first job is to hang out with the good 20 and avoid the bad 20. What makes the business a little easier is that if you put either 20% through the same performance dispersal curve, the curve conformably aligns again. In English, that means that 20% of the 20 does 80% of the 80, or 4% of the population generates 65 or so percent of the utility in the sector. So you try to determine who the best 4% are. And I learned, probably in my late 50s, that this super performer lip aligned conformably one more time, so that 1% of the population generates 45% of the utility. What that means is that to the extent you can, you hang out with the Friedlands. the Lundins, the Quartermains, the Beatties, and you ignore all of the rest of them. Had I, when I was 35, never done business with anybody who hadn't already made me realistic money by the time I was 35, in other words, by the people who were already established as the best of the best in the first 10 years of my career, I would have worked, 25% of hard and made probably twice as much money.
Interesting.
That's a hard lesson because we're programmed to do something, not nothing.
Yeah.
The third mistake that people make is that they think their time preference matters, and it doesn't. When I look back at the 10 baggers in my career, the 20 baggers or the 30 baggers, the average holding period was in excess of 5 years. And in those 5 years, almost every time I was exposed to a 50% share price decline at one point in time or another. So I had to have A, patience, and B, the courage of my convictions. Aaron, I don't know if you know this, but over 35 years, I've graded almost 100,000 portfolios. I rank people's portfolios at my website for free. And I've done that almost 100,000 times. And I've learned a hell of a lot about the things that people get right and the things that people get wrong. And I've called several thousand people when their portfolios interested me or amused me or annoyed me so that I could learn more. And I learned time and time again that people have often the right idea, which is to say the right strategy, and the wrong tactic. If you believe, as an example, as I do, that 3 decades of underinvestment in the copper business means that we're going to have systemic shortages in the copper market over the next 5 or 6 years, no matter what we do, and you buy a copper stock, but your time frame is over a long weekend, rather than 5 or 6 years, the dichotomy between your tactic and your strategy means that you likely won't lose money, won't make money. And that's a tragedy.
So this is applicable to juniors, and I want to get your take on it. One area that I still struggle with, in the junior mining space, is knowing when to sell. I've had positions where the fundamentals improve, the project is proven out, gets to feasibility, whatever. Stock goes on a great run. I take profits, and then it inevitably keeps going 3, 4, 5x more. How do you think about exit discipline when it comes to juniors? What I'm trying to say is, are there specific markers that you look for, fundamental, market, or behavioral, that tell you, hey, it's time, it's been a nice run? How do you do that? How do you, with the juniors?
It's a tough discipline, but valuation. Money is always made of the delta between what something is selling for and what it's worth, or what you think it's going to be worth. That's the first thing. But the second thing, Aaron, think about the statement that you just said, and think of what might be the fallacy in that statement. You buy a stock, you're right, it goes up, you make a bunch of money, and you sell. Is that the greatest sin you're ever going to commit?
It's a good problem. It's a good problem to have.
If the next guy makes some money, that's okay.
Yeah.
That's okay. What I do, and I'm not trying to say it always works, it doesn't, but it works for me more often than it doesn't, is that every time I buy something, I write myself a memo as to why I bought it. What I think it's worth, which is to say, what I think my downside is, what I think it could be worth, which is what my upside is, what are the conditions precedent to it becoming worth more, what's the time required for the test, and what's the cost of the test? Mm-hmm. How will I know if I made a mistake? What will cause me to sell if things go wrong, and what will cause me to sell if things go right? And that's made me, I review all of those every 90 days for every investment.
That is great.
And made me a better investor. So as an example, 2.5 years ago, 3 years ago, people hated silver. They just hated it. And I love hate. So I thought, yes, I should buy some silver stocks, but I should actually buy some physical silver, because the physical silver will move before the silver stocks. So I tied on a speculative position in silver, or more specifically, the Sprott Physical Silver Trust, because I was too lazy to go to a bullion dealer. And I was right. the hate disappeared. I thought the price of silver could go to 50. I was wrong. I went to 75 or some number, right? Not a bad mistake. Now, for me personally, the reason I bought that position went away. So I sold the position. Do I think the silver price is going to go up?
In a world of rising deficits, currency dilution, and market volatility, many U.S. investors are choosing to diversify their retirement accounts with assets like physical gold, silver, and even crypto. This video is sponsored by iTrustCapital, which offers a platform for Americans to hold physical gold and silver, as well as crypto, directly inside a tax-advantaged IRA. Designed around transparent pricing with clear premiums over spot and no hidden storage fees, iTrustCapital offers something that still isn't standard in the precious metals IRA space. So if you're a U.S. investor looking to learn more about owning gold, silver, or crypto inside an IRA, use the link in this video description. Americans may be eligible for a $100 funding bonus when opening and funding an account with iTrustCapital.
Probably. Do I care? Absolutely not. That silver fulfilled the role that I had assigned it in writing in my own portfolio.
Okay.
Similarly, in October of last year, I'd been an aggressive buyer of juniors in the market for 6 years. Yeah, I had lots left over from before then. But let's just talk about new money. I'd been an aggressive buyer. And in October, we had this incredible financing window. And stuff that hadn't seen a bid forever was on fire. The reason that I owned some of those stocks went away. And so I sold 25% of my juniors in October. By selling 25% of my juniors, I recouped all the capital that I had in the sector, and I paid capital gains tax on the sales. So I sold off 25% of my upside, and I eliminated my downside.
Mm-hmm.
Now, for a 73-year-old guy, giving up 25% of your ups in return for reducing all of your downs is a hell of a print.
Mm-hmm. Mm-hmm.
That basket of stock is worth more today than it was in October. So obviously I sold too soon. Do I care? Not at all. I fulfilled my goals.
Mm-hmm. That's good advice. That's you probably sleep well at night. I kick myself for some of the early sells, but I like that. That's actionable advice.
There's two kind of errors, Aaron. Maybe more, but there's two kinds that I know how to commit. There's errors of omission. That's where you miss something, like you miss out on some gains. Or there's errors of commission, which is where you lose money. I prefer errors of omission to errors of commission.
Well said. Well said. One thing I love listening to you and chatting about is the Unloved, your specialty, right? You turned me on to Cameco, I don't know, 5 years, half a decade ago or something. Did very well there. Last time you were on the show, you suggested I take a look at Cato. I did my due diligence, bought it, pays a nice dividend. It's appreciated nicely. The Unloved, let's talk about the commodity that's unloved. Last time for you, I asked you what metal it was. You said it's not a metal, it's natural gas. When I look at the hated in the metals space right now, first thing that comes to mind is nickel.
Yep.
What do you think about nickel?
You're right. It's an industry that's in liquidation, which I love. And it's an industry that the ongoing demand for is assured. I mean, yes, you can substitute other stuff for nickel, but they're so inefficient that you can't do it for any price point relative to today. So what's going to change? The thing that depressed the nickel price was lateritic nickels, specifically, mostly Indonesian lateritic nickels.
Yeah.
Is this going to change? I think yes. A year and a half ago now, I flew over southern Sulawesi where these nickel mines are. Nobody could accuse me of being Greta Thunberg, but the environmental devastation I saw out of the plane window astonished even me.
Wow.
Pre-stripping by pushing lateritic soils into the sea.
Wow.
Smothering the coral reefs for miles. And we started to see a circumstance now where the incredible environmental devastation of the lateritic nickel industry in southern Sulawesi is unacceptable to the Indonesian people and the Indonesian government.
Yeah.
We're starting to see now where the operating costs to produce this nickel are increasing dramatically. I expect them to increase between 30 and 35% from 2025 levels, and quickly. That means that the pricing floor goes up by 30 or 35%. In addition, lateritic nickel is energy intensive. I think that we're in a period of anomalously low oil prices. So the conjunction of increased environmental cost and increased energy prices means that the sulfide nickel deposit that are less viable today become much more viable 3 years from now. And mercifully for me, most of my competition, even people half my age, think that 3 years is an eternity. I've now lived through, 25 3-year periods.
For background on what's happened in the nickel space, and correct me if I'm wrong, but Indonesia's basically flooded the market are they subsidizing their mining?
Oh, you could argue that the Chinese are subsidizing their market. The Chinese banks, state-supported banks, have made loans to Indonesian and Indonesian Chinese nickel producers. One could argue below the cost of Chinese capital, because access to these lateritic nickels has dramatically lowered the price of steel production in China, particularly stainless steels. So the Indonesian government, probably to their credit, said to the Chinese, you can't come and mine nickel here. You have to beneficiate the nickel and turn it at least into pig iron locally. You have to process it here before you ship it to China. And so the Indonesian government has forced the Chinese to spend $10 or $12 billion on processing facilities. Far from a subsidy, they've in fact imposed a cost in order to benefit all of Indonesian society. While it pains me to say that any government ever at any time did anything good, that's probably a policy that I object to less than most.
Yeah. So when you look at the potential winners outside of Indonesia, I would assume it could be, speculating, but Australia for nickel, Canada perhaps. Are these some of the countries that you think there's opportunity in?
Yeah, I mean, any country with good ultramafic deposits. This could include a Canadian listing called Lifezone, which operates in Tanzania, a deposit that I've been around for 35 years so far with no love. Certainly includes the Canadian deposits in the Sudbury Basin, juniors like Magna.
Yeah.
It includes the Australian producers around Kambalda. Also the byproduct nickel production in South Africa from PGMs, and the byproduct and primary production from Para State, the Carajás in Brazil.
How do you feel about nat gas these days? It's had a little bit of an uptick since we spoke, but you still like it?
Yeah, I do. I mean, particularly Canadian natural gas. In the U.S., one could argue that most of the easy money's been made. The gas price is cleared from basically zero, where they had to give away byproduct gas from oil production, to something like $4 per MMBTU. When I was on your show last time, I talked about the fact that the very low natural gas prices in the U.S. were causing literally billions of dollars of infrastructure to be made, to be invested in. And also that we were witnessing in real time the onshoring of the German petrochemical industry, which was relying on Russian gas to the U.S. Gulf Coast. That's done. I mean, I'm not going to say it isn't going to continue to be important, but that $100 billion in infrastructure has been spent, and the German petrochemical makers are now resident in the U.S. Gulf Coast and using U.S. gas. But it's not done in Canada. Not that Americans should lecture other countries on politics, But you've had a change of government, kind of, at the top. I say change. That the liberals replace the liberals. But it would appear that your current prime minister is at least numerate, whereas your prior prime minister was clearly innumerate. And it would appear that Mr. Carney, despite the fact that he said that carbon would be the center point of any financial discussion, also understands that his new budget, is predicated on revenue. You'll remember that your prior prime minister said the budget would balance itself.
Yeah.
And I believe that Mr. Carney will be more pragmatic in his anti-energy stance.
I hope you're right.
The most efficient industry that Canada has is oil and gas. The easiest place to steal government rent is oil and gas. And my hope is that Mr. Carney is cognizant enough of that he moderates some of his anti-oil stance. The Canadian oil and gas producers sell at a substantial discount to the U.S. producers. And the U.S. producers are selling at a discount to net asset value. If you can deal, not as to 100%, but if you can deal with 50% of the political risk to Canadian oil and gas, there's a huge bump. Your prior prime minister actually said, there is no business case for the export of Canadian gas.
Yeah.
He had a whole bunch of customers that were telling him different. Yeah. What I guess he was saying is that since my mind is made up, and since I'm going to shoot my foot off to spite my face, that there's no business case. And I don't think that Carney's that dumb. I hope not.
Well, that's a nice, optimistic way to end it. Rick, before I let you go, where can our viewers find more about you online?
All over the place. I failed retirement completely. If you like what I have to say about natural resource investing and you want to personalize it, go to my website, ruleinvestmentmedia.com. List your natural resource stocks, ruleinvestmentmedia.com, and I will personally rank them. No charge, no obligation. Rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues like Pato if I think my comments might have some value. The second thing I have is something called the Rule Classroom, where there are well over 300 hours of instructional material available, including how to analyze natural resource stocks, and it's free. All of my free services, by the way, have a full money-back guarantee. That's easy to do. And then finally, once a year, I put on the finest natural resource investment conference in the world, bar none. The reason I can tell you that is it's the only one that has a full money-back guarantee. Whether you attend live, July 6th through 10 at Boca Raton, Florida, or join 2,000 other people worldwide to attend live stream, we have an absolute solid gold money-back guarantee. If you don't think for any reason whatsoever that you don't think you got your money's worth, we give you your money back. Nobody else does that. Only us. Finally, if you're American and if you're Canadian, and for some reason you're unhappy with your current bank, I've got a new bank, Battle Bank, open, I should say, February 17th, to Americans and Canadians. Let's suppose for a second that you were a Canadian and had money on deposit and made the mistake of exercising your freedom of speech and gave a donation to the truckers. If Mr. Trudeau went to Royal Bank to freeze your account, they complied. If Mr. Carney came to me in the United States to freeze your account, I would present him with the international high sign of unfriendliness. Our bank allows you to save in 20 currencies, not just the Canadian dollar or the US dollar. Our bank, if you're a holder of physical gold and silver, will allow you to access the capital you have tied up in your gold and silver by establishing an equity credit line without having to sell your gold or silver.
Mm-hmm.
Compare those services with the services that you enjoy from your current bank. And if you find your current bank wanting, go to battlebank.com.
One more question, Rick. Spent your life in natural resources. What made you want to start a bank? There must be a ton of regulation around starting a bank.
It is a ton of regulation, but it's my 7th bank.
Wow.
I learned enough about financial services, providing natural services to natural resource investors, that I came to be familiar with banking, with asset management, with wealth management, and with insurance. I've provided and invested in all of those services, and running financial services businesses caused me to understand how to value financial services businesses. It also caused me to understand how to recognize opportunity. The banking business is a wonderfully good business. In effect, you're a used money salesman. You just need to not make mistakes. You need to be disciplined. And I would suspect if I have any competitive advantage in business, it's that I'm an entrepreneur. I'm pretty good at spotting opportunity where other people haven't spotted it. And I'm pretty disciplined. I'm less inclined to make mistakes. And those have served me well. The last bank we built was called EverBank, one of America's first online banks. We built the bank. We opened it in 2000. We grew it from zero to $28 billion in deposits and sold it in 2024. So it was a very successful effort.
Wow.
The people that we sold it to, good people, was TIAA Crefts, and their credit base were retired teachers who were very different than our customers. And the consequence of that is that they bought the bank, their corporate culture predominated, and they abandoned our 275,000 customers.
Whoa.
So we want to go get them back.
Got it. That's impressive, Rick. I
had a ball doing it.
I bet.
I wouldn't suggest that starting a bank is a good activity for somebody who actually is contemplating retirement.
Yeah.
And I need to say that the regulatory challenges around starting a bank have been anything but pleasant.
Yeah.
But banking, identifying depositors' needs, identifying borrowers' needs, helping young employees actualize the talents that they have in building a business and building their own personal wealth. If it didn't make so much money, I'd do it for free.
I'm super grateful for your time today, Rick. But on a personal level, just over the years, before we even started chatting, you've been a virtual mentor to me and teaching me how to evaluate opportunities, particularly in the resource space. So I appreciate all you do, man. I know you could be lying on a beach somewhere, but the entrepreneurial spirit continues to drive you, and you have a lot of people who appreciate it, I'm sure. So thank you very much for your time today, Rick.
Well, I appreciate the fact that you use the word mentor. I do what I do in substantial measure to honor the debt that I have to the Seymour Schulichs and the Ned Goodmans and the Peter Kundals, all the people who mentored me in my youth. They literally gave me hundreds of hours with no expectation of recompense. And I owe them all of my successes. Sadly, I can blame them for none of my failures. So to not pay that mentorship forward would be a sinful dishonor of the debt I owe to my mentors.
Oh, well, you're definitely paying it forward. That's it's appreciated. It's appreciated, Rick. So thank you very much for your time today. As always, it's been a pleasure.